Nvidia added more market value in a single year than the entire GDP of Saudi Arabia. One company, 1 year, $1 trillion, and the wildest part? Most of Wall Street said it was a bubble the entire time. You're watching Wealth Ranked. Let's rewind. In January 2023, Nvidia was a $360 billion company. Impressive, sure, but it was mostly known for making graphics cards for gamers and crypto miners. Fast forward to early 2026, and this company has crossed $3 trillion in market cap, making it one of the most valuable companies on the planet. That rise didn't happen slowly. It happened violently. And the people who called it a bubble at $500 billion are still calling it a bubble at $3 trillion, which tells you something important about how most people understand money. But here's where it gets insane. Nvidia's CEO, Jensen Huang, saw this coming a decade before anyone else. While the rest of Silicon Valley was chasing social media and mobile apps, Jensen was quietly building the infrastructure for a revolution nobody believed in. He bet the entire company on a technology called CUDA back in 2006. That decision, which Wall Street analysts called reckless at the time, is the single reason Nvidia dominates artificial intelligence today. CUDA let developers use Nvidia's GPUs for general computing, not just graphics. For years, almost nobody cared. Researchers at universities tinkered with it. A few machine learning labs experimented. The stock went nowhere. Between 2008 and 2015, Nvidia shares barely moved while Apple, Google, and Facebook were minting money. Shareholders were furious. Activist investors pushed for Jensen to cut R&D spending and return cash through buybacks. He refused. He kept burning cash on research when shareholders wanted dividends. He kept hiring engineers for a market that didn't exist yet. One former board member reportedly told Jensen he was building a cathedral in the desert. That cathedral is now worth $3 trillion, and that's not even the craziest part. When ChatGPT launched in November 2022, it triggered the largest corporate spending spree in human history. Every tech company on the planet suddenly needed GPUs. Not next year, not next quarter, right now, and there was only one company that could deliver at scale. Nvidia had a near monopoly on the exact hardware the entire AI industry needed, and they'd been building toward that monopoly for 17 years. The numbers are staggering. In their fiscal year 2024, Nvidia's data center revenue hit $47 billion, up from $15 billion the year before. That's a tripling. Their gross margins sat above 70%, which is almost unheard of for a hardware company. For context, Apple's gross margins hover around 45%, and Apple is considered one of the most profitable companies ever. Nvidia's net income in a single quarter exceeded the annual revenue of most Fortune 500 companies. They made more profit in 90 days than Ford Motor Company makes in an entire year. Let that sink in. But here's where it gets really interesting. The bears weren't entirely wrong. History is littered with companies that looked unstoppable and then collapsed. Cisco in 2000, Nokia in 2007, BlackBerry in 2010. The pattern is always the same. A company dominates a new technology, the stock goes parabolic, everyone says this time is different, and then competition catches up, or the market shifts. So why might Nvidia be different? 3 reasons. First, the switching costs are enormous. Nvidia doesn't just sell chips, they sell an entire ecosystem. CUDA has millions of developers. Every major AI framework is optimized for Nvidia hardware. Switching to AMD or Intel or a custom chip means rewriting millions of lines of code. Companies don't do that unless they absolutely have to. Second, Nvidia moves faster than its competition. While AMD was trying to catch up to Nvidia's A100 chip, Nvidia had already shipped the H100. While competitors were benchmarking the H100, Nvidia announced the H200. And while everyone was digesting the H200, Nvidia unveiled Blackwell, their next-generation architecture that promised to be dramatically more efficient. They're not just ahead, they're accelerating away. Third, and this is the part most people miss, Nvidia is becoming a platform company. They're not just selling hardware anymore. They're selling software, cloud services, networking equipment, and complete AI infrastructure solutions. Their acquisition of Mellanox for $7 billion gave them control of the networking layer that connects GPUs in data centers. That's like selling both the engines and the highways. Their software stack, called Nvidia AI Enterprise, generates recurring subscription revenue that didn't exist 3 years ago. Nvidia is quietly building the toll booths on the AI superhighway, and every company that wants to use AI will have to pay the toll. Now let me tell you who actually got rich from this. Jensen Huang himself went from a net worth of roughly $12 billion in early 2023 to over $100 billion by 2025. That's the fastest wealth creation for a single individual in the history of capitalism. But he's not even the most interesting story. The real winners were the early employees. Nvidia has created more millionaires per capita than almost any company in Silicon Valley history. Engineers who joined in 2015 with stock options worth maybe $200,000 were suddenly sitting on $5 to $10 million. Secretaries and marketing coordinators who took equity instead of higher salaries became multimillionaires. In the neighborhoods around Nvidia's Santa Clara headquarters, real estate prices jumped 30% in a single year because of the flood of newly wealthy employees. Car dealerships in the Bay Area reported a spike in Ferrari and Porsche purchases from Nvidia badge holders. Local restaurants started seeing $500 dinner tabs from people who'd been eating at Chipotle a year earlier. The wealth effect was visible and immediate. But here's where it gets insane. The institutional investors who made the biggest bets also made the biggest money. Vanguard and BlackRock, through their index funds, collectively held over $300 billion worth of Nvidia stock. Those aren't active bets. That's just passive indexing, which means regular people with 401k retirement accounts were accidentally becoming Nvidia investors and benefiting massively. On the flip side, the short sellers got obliterated. In 2023, short sellers bet over $18 billion against Nvidia. By the end of 2024, those positions had generated roughly $12 billion in losses. Some hedge funds closed entirely because of failed Nvidia shorts. One fund manager famously compared Nvidia to Cisco in 2000 at every conference he attended. His fund shut down in Q3 of 2024. The total losses for Nvidia short sellers between 2023 and 2025 exceeded $30 billion, making it one of the most painful short squeezes in market history. Now the question everyone wants answered: is this sustainable? Here's the honest truth. Nvidia's revenue growth will slow. It has to. No company triples revenue forever. The question isn't whether growth slows, but whether the market has already priced in the slowdown. At a forward price to earnings ratio of around 35, Nvidia is actually cheaper relative to its growth than most big tech stocks. Amazon trades at a higher forward PE with slower revenue growth. The real risk isn't competition or valuation, it's demand. Right now, the AI spending boom is being driven by the expectation that AI will generate enormous returns. But so far, most companies haven't figured out how to monetize AI at scale. If that changes, if companies decide the return on their AI investment isn't worth it, they'll cut spending. And Nvidia's revenue is almost entirely dependent on companies continuing to spend aggressively on AI infrastructure. There's also a geopolitical angle. The US government has restricted Nvidia's ability to sell its most advanced chips to China. That's a $10 billion annual revenue hit that Nvidia has tried to work around with modified chips, but it's an ongoing headwind. And if US-China tensions escalate further, the restrictions could get worse. China is also pouring billions into developing domestic chip alternatives. Huawei's Ascend chips are already being used for AI training inside China, and while they're still behind Nvidia's best, the gap is closing faster than most Western analysts admit. But here's the bottom line. Jensen Huang made a bet in 2006 that took 17 years to pay off. He endured years of criticism, years of flat stock performance, years of analysts telling him to give up on CUDA and focus on gaming. He didn't flinch. And when the moment came, when the world suddenly needed exactly what he'd been building, Nvidia was the only company ready. That's not luck. That's not a bubble. That's what it looks like when preparation meets a once-in-a-generation technological shift. Whether the stock goes up or down from here, what Jensen built is already one of the greatest business achievements in history. Subscribe to Wealth Ranked. We rank the biggest money stories on the planet. See you in the next